So Alan, Chapter 4 are really the closest thing we have in the FRM Part 1 to case studies, where basically he goes through some of these more public risk management failures as case studies, and tends to categorize them in the following three buckets. The cases where there was misleading reporting, cases where there was an unexpected market move, and the banker's trust case where the issue was bad conduct of the customer-facing business. So in the case of Chase Drysdale, Drysdale obtained $300 million in unsecured borrowing, but only really had $20 million in capital. Then lost money in the positions and could not repay the loan. Drysdale went bankrupt, and there was a stock price impact and some reputational damage to Chase, the parent. Key factors here are Chase failed to detect the unauthorized positions. Chase did not believe the firm's capital was at risk. It relied on the judgment of inexperienced managers and did not correctly interpret the borrowing agreements. Key lessons learned: more precise methods should have been used to compute the collateral value. And there should be, this is a fairly thematic and historical cases, new products are deployed without really a rigorous process. So one of the lessons there was the need for process control. New products should receive prior approval from some independent and objective risk function. Kidder Peabody, between 92 and 94, Joseph Jett exploited an accounting type glitch in order to book about $300 million in false profits on government bonds. Key factors are, and in hindsight, this looks almost laughable, but this was 20 years ago. The system did not present value the forward transactions, so that allowed him to book artificial profits. Also, again, another typical feature of these historical case studies, there were red flags, if not overt whistleblowers. There were at least suspicions, and management did not react to those danger warnings or red flags or signs. So in many cases we see that if management's proactive in listening, that they can certainly identify the problems. Sometimes it seems to be the case of hear no evil. Lessons learned: investigate a stream of large unexpected profits. So we've seen that lesson more than once. If something's too good to be true, if it looks like a free lunch, this reminds me of the Madoff case, right? If the return sequence is just up in a linear fashion, in finance we're sort of trained to be suspicious of these free lunches. So that's one of the key lessons there. And then periodically review models and systems. Do the assumptions need to be updated? In the case of Barings, during 1993 to 95, a junior trader took large speculative positions from the Singapore office and disguised as safe transactions on behalf of fake customers. And the losses of $1.25 billion forced Barings into bankruptcy. So factors included market risk. Leeson was short straddles, hoping index would trade in a narrow range. So we know that the short straddles is short volatility. However, after the Kobe earthquake, it sent the index into a tailspin, and the earthquake increased volatility, which exploded the short positions. There was also credit risk, a management of counterparty risk, and reporting of specific instrument exposures to counterparties would have been an additional signal. So the key factor: Leeson was allowed to settle his own trades, management incompetence and poor supervision and poor reporting. Lessons learned included an absolute necessity of an independent trading back office. So this right here is is thematic. It's a real key point coming out of the cases. Also popular on the exam, I think. I really like to tease this one out. The fact that we need to separate we can't have one person here settling their own trades, basically overseeing both with the ability to oversee both the front end and trading a back office. There needs to be some independence of the back office, a separation of the trading and settlement functions, and a need to make thorough inquiries about unexpected sources of profits. Allied Irish Bank, John Rusnak, a currency option trader, entered into massive unauthorized trades from 1997 to 2002, producing losses of almost $700 million. Was supposed to be running the small arbitrage, but was disguising large naked positions. Key factors, similar to Leeson: internal deception, achieved by inventing imaginary trades. Lessons learned include proprietary trading or prop trading is a high-risk activity. Risk management architecture is crucial. The relationship between parent and overseas units needs to be clarified, and a need for strong and enforceable back-office controls. Long-term capital management. So this is a popular case. From 1994 to 98, several famous quants produced spectacular returns with their relative value or arbitrage type trades. In the summer of 1998, however, a series of unexpected and extreme events caused the need for the New York Fed to step in and coordinate a private bailout. Sometimes misstated as a public bailout, and the New York Fed did participate and coordinate, but technically that was a private bailout of $3.65 billion in equity. Key factors: the failure to supplement VAR with a full set of stress test scenarios, failure to account for illiquidity positions during stress, and maybe leverage too high, maybe too much faith in the models. These are in parentheses because the author cites them as popular criticisms that the author does not quite agree with. So we include those as itemized lists in the key factors. Lessons learned. So this is very FMR thematic. The need for stress testing and scenario analysis. What he here calls stress scenarios. We tend to parse those into two, but you get the point. We need to complement VAR with stress testing and or scenario analysis. The need to incorporate liquidity. Initial margin needed if the counterparty is a trader, and greater counterparty disclosures. I have some additional key factors listed in the slide, really by nature of the previous case study, which in some ways, in the FRM, which in some ways is a little more detailed. So, if we want to get the full set of risk factors on the table for long-term capital management, it's a little bit depends on the historian and the point of view, and B, it's potentially a long list, definitely including model risk. And the Meta-Gesellschaft, also popular in the FRM case studies because it's such a classic example of basic risk. So here, the firm was selling long-term forward contracts to sell gas or oil. And so we can think of that as the underlying position. Short positions, the underlying would be a short position in long-term forward contracts. And then they hedged that with a stack and roll hedge, which is long. So that's the hedge instrument, right? Keep in mind, a hedge always has two positions. Here's the underlying exposure. That's the business that Meta-Gesellschaft is doing with its customers. And then hedging that with a stack and roll, which is to successively take long positions in short-term futures contracts and roll those over. Now, it worked for a while, as historically that oil forward curve was in backwardation, and the roll yield in backwardation is profitable. You roll into successively higher forward prices as the maturity shortens. So one of the things that happened here was spot prices dropped and the oil futures curve shifted into contango, and these the roll yield in contango turns into a roll loss pretty quickly and pretty dramatically. So I do have a dramatic that I've used for a while, a graphic that I've used a while on this, just to stylistically summarize. But here we have the underlying exposure, right? Meta-Gesellschaft, basically in the underlying business, entering into a short position long-term forward contracts. That is to say, a guarantee to sell this oil and gas at a future price to the customer. And so how to hedge that? Well, hedge that with a long position in short-term futures. And so you can see right away there's a maturity mismatch. The underlying exposure here is short, a long-term position, hedged with long, a short-term future position. So the stack and roll, because these are short-term futures, and now part of the motivation may be valid there, right? It may just be that these 5 to 10 year commitments may just lack liquidity in 5 to 10 year futures market. That probably was the case. However, I've several years with this case. I think there's also the distinct possibility, more cynical motivations. Those futures contracts under the backwardation were simply profitable. So there was certainly a profit motive that could help justify the use of the stack and roll hedge. But so here we have the underlying hedge. I should say the hedge to the underlying exposure here. And then that backwardation in the oil forward curve was profitable to the short-term stack and roll, because each of these short-term maturities, it gets to roll over at a higher price. And then the adverse of the event was the shift to contango, which makes the rollover in the stack and roll that produced losses very quickly. Now, under the accounting regime that they were subject to, these forward contracts were not marked to market. So what happened here is, in the backdrop, just in the overall event, if Meta-Shelgaf had not been hedging, they would have been fine, because these long-term forward contracts became profitable. Right? Basically, the price of oil had dropped, and they essentially here, by guaranteeing to sell at a price, were short the position, and so they were profitable on the underlying. So the irony here is, without the hedge, they would have been fine. Okay, but it's worse than that, because without the hedge, before the hedge, they're actually making a profit here, but they can't book it. These are forward contracts, not futures contracts. They're not being marked to market daily, and they're not, in their case, they were not able to book those gains. On the other hand, they had to mark to market what they were using to hedge with the futures contract on a daily basis, and they suddenly were losing, gaining on the underlying, losing on the hedge, but they only were booking the losses. So it's the hedge instrument that had to be booked that created the losses, that created the problem, ironically. Key factors: the stack and roll hedge exposes the company to basis risk. The shift to contango created losses on the roll return, and accounting standards required recognition of future losses, but without the benefit of booking the forward gains. Lesson learned: short-term hedge against long-term contracts requires liquidity. So, especially after the crisis, we're very sensitive to these maturity mismatches. Uncertainty of the roll returns and liquidity consideration may favor other than the minimum variance hedge. So just to reiterate, the first factor was that the market shifted to contango, and this greatly increased the cost of the stack and roll hedge. Or actually, if you look at the numbers there, and if not this case study, some of the more detailed case studies I looked at, it really was that, as I've been saying, and I said that out of deliberation because I've looked at those numbers, that it was the roll yield in contango that produces the dramatic losses that cause the margin calls. And then the second factor was the accounting methods that put them in this position where they had to recognize the losses. And Bankers Trust, to reduce their funding expense, Procter & Gamble and Gibson Greening bought complex derivative products offered by Bankers Trust. So here we have the classic case study of really, and the way I look at this case is, it was complexity was the problem. We've certainly seen this subsequently in the financial crisis, for example, with the Abacus CDO and some of these complex instruments. And then it quickly becomes apparent that the buyers, although they should have been responsible, and the investors should certainly understand their long positions, they have that fiduciary responsibility. In many cases, they just did not understand the complex derivative. So due to the losses here, the customers sued Bankers Trust. Key factors: complex derivatives, and evidence to some extent of evidence of some intent to deceive. So they got a hold of I can't remember if it was emails or voicemails, the internal voicemails and or emails between Bankers Trust employees really revealed that they knew that the clients didn't understand what they were buying. Lessons learned: better controls for matching complexity of trade with client sophistication, the need to provision price quotes independently of the front office, and implications of internal communications that can later be made public.